Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone again. Happy Monday, March 17th. I'm going to start with a few disclosures. Now, I want to just tell everyone that last week on our Market Trends webinar on Thursday, we had basically talked about the changing calendar and the fact that we had NVIDIA's event this week along with the Fed meeting. And we mentioned after 4 weeks of solid downside, it did create some potential for the selling pressure to pause. And we highlighted a potential price zone about, oh no, 50 points higher from here on the S&P. And that zone remains in effect. We're going to, circle back to it. But I want to just mention that, we last week had kind of looked at the calendar and, technicals are nice and they're very useful, but they're not the only way to understand sometimes some of the way the market wants to move. Also, sometimes just being aware of the calendar of events can really help you. So we're just going to start off by showing some standardized returns of some ETFs that we're going to be talking about here. Let me actually provide also a link to the disclosure page and some other things, the ETF prospectus page, if you want to check that out. We actually recently added a new ETF, which is EFA, because global is an emerging theme. Now, EFA is not something that's highly traded, but it's useful as an index. It tracks, I think it's MSCI's global index, which is a major index. So I want to just kind of tell you that. So this is the right here, TradeStation platform showing the standardized returns of some of these ETFs. Now, I also want to very briefly show two other things. First, actually, you know what? Go to tradestation.com. And if you go to tradestation.com and you click on Insights, this is our blog right here. And on the top, there's an article which highlights some important points. It has this the AI image. And this is a lot of things we're talking about are highlighted in this article, some of the key points we're talking about if you want to check it out. But wanted to just kind of mention that at this moment, we look overall at the S&P. I think we have to realize is that the market's come down a lot, and we could see some days of kind of strength here. But I think we also have to realize that there is some risk in the quarter end. There's the potential for some selling into the tax day with people potentially facing, big capital gain taxes and stuff. Those are all potential things that are kind of out there that really do drag us out into April. But I think one of the big things also is the fact that earnings estimates seem to be moving in a negative direction. We entered with extremely positive expectations for earnings. Those things are moving in the opposite direction here. And I think we look at some of the economic data like we've had today, it continues pointing us in that direction. So I think we do have a little bit of some potential here. When we get through these events, something like the Fed will be a big milestone for the week. Tomorrow, Jensen Huang speaks at 1 p.m. Eastern, CEO of NVDA. So these are big events this week. But then I think we kind of push out, as the week moves on, people might look for, some signs of things kind of peaking. So I want to just kind of mention that. Now, before we can get onto the S&P, I do want to show you EFA. I did a trading view idea on this today. And if you look, I actually shared the link to our trading view ideas, for the TradeStation trading view ideas. And this is the one here if you want to look at this one, Global ETF New Year's Potential Breakout. So a lot of things on here, but including some real relative strength. The fact that we had this bullish outside week, we're inside, we completed a week here inside of the preceding week. We held this support zone. So if you look on the weekly chart now of EFA, this tracks a lot of global markets, mostly Europe and Japan. But we had right here an inside week, and we also held back here. We more or less held above this level from mid-December. There was also a 50% retracement of the move. So right now, if you look at this thing on a very long-term chart, I mean, this has essentially gone nowhere. I'm going to make this in the monthly candle so you can really see. This has really gone nowhere for a very long time. And, I think some people could actually make the argument that there is a sea change in terms of the global environment, with American valuations being relatively high, American economic numbers and earnings potentially weakening for the time being, and the European scenario potentially getting more positive with the with Germany getting ready to lever up their economy and do some infrastructure and defense spending. So those things all, I think, are coming in and building into this argument. So I want to just kind of point this out, that this pattern in EFA, going back to the weekly rules just quickly, is a very tight, with a strong rally, a lot of tightness. Remember, this strength happened as the S&P was getting hit pretty hard. So we see some real relative outperformance here. So check out the trading view idea on that. You can see we really get into some detail on it. So I wanted to mention that. I also think it's important to realize that, well, first, let me mention that China announced some kind of ambiguous stimulus thing, and they're going to be announcing more next week. So we have a special kind of article coming out tomorrow on Alibaba. If you want to check that out on Market Insights, we're going to be breaking down some of the catalysts coming up in China, and Alibaba in particular. It's one of the biggest Chinese companies in the United States. Also, today saw an article that Warren Buffett continues to buy Japanese securities firms. It's kind of interesting. He's shying away from U.S. equities, and he's buying more Asian investment banks and stuff like that. So just an interesting nuance. I think it's interesting. It sort of shows that there's a lot of smoke now for this fire of the global rotation away from U.S. equities. People were saying for a long time Mag 7 was too expensive, and now we're seeing a lot of anecdotal evidence along the way. So I want to just emphasize that. And then if you look, for example, before we even get to the S&P, I want to just really quickly mention here. Look at the Dow Jones Transportation. This is now on a weekly chart. Really has been, very much kind of giving the traditional Dow theory of economic weakness. We've seen weakness in a bunch of the airlines cutting estimates. We have seen weakness. Let me show you very quickly over here on a daily chart of something like Home Depot and Lowe's. They both put out weak guidance. I'm hitting these very quickly just to show you that we have something coming right now of concern about earnings and cyclical economic activity. So look at LOW. This is basically here showing us that we have, Lowe's reported earnings slam lower. Home Depot, same way. Ross Stores, similar sort of thing. Look at Teradyne, which is a semiconductor equipment company. Look at Hewlett Packard Enterprise. Adobe got hit. So there's really been a negative reaction to earnings here. And I think when you consider the fact that we enter this, earnings or more or less enter this calendar, you're looking for double-digit earnings growth in Q1. It's more or less been cut in half now. And I think that we still have more time to go until those earnings come out. So I want to just mention that. Now, let me also just be clear that the kind of hinge event this week still is the Fed. So I think we're in a spot here where we've had a lot of weakness and there's space for a rebound to the levels we're going to get to. But I want to just kind of lay out some of the ways I think people might be kind of thinking. I also want to show you that Atlanta Fed GDP now is also at a spot where, it continues to show, some weakness here. We're starting to see the actual real official estimates work their way lower as well. So these things are kind of consistent with that. And so I think, I would just mention that I think we have to at least bear in mind the potential that we might be seeing a bona fide longer term structural shift away from Mag 7 large cap US stocks toward other kind of companies. How long it will last, all those things are unclear. But the fact is that we have had a certain regime for a long time. And if we do see a shift away from it, that shift might last, more than just a few weeks. It might be something we're talking for a few quarters or something like that. So, Mark Douglas, the great kind of trading philosopher, said that you have to be open to the now flow of possibilities, the things that might be happening. And I think in an environment like this, if we truly are seeing a paradigm shift in the market away from these large cap US stocks and things like that, we have to be careful of seeing value, and people looking for value too quickly, because the fact is that when growth stories get broken, they can be broken for a while. And it's really difficult for a growth stock to become a value stock. A growth stock goes up because people look out into the future and they see its business growing. And if they don't see its business growing, they're not going to necessarily say, wow, it's cheap. They're just going to not be interested in it. And I think you have to realize that for secular growth, it's important to really have that growth in place. And so I think we have to realize is that we might be seeing a more bona fide shift. And there seems to be some evidence of it happening. Today, the retail sales were very poor. Empire Index, not a hugely important report, but it is the first March data that we've seen. And that basically showed higher prices, higher inventories, and weaker orders. That's not consistent with a strong economic environment. It's more of a stagflationary data, but at the same time, Empire Index is like a little niche and it doesn't always match the bigger picture. But the National Association of Home Builders, NAHB, was really weak as well. They also showed higher costs. They said costs are adding something like $9,200 to new homes because of tariffs. Now, they're going to try and talk it one way to sway public opinion. But at the same time, I think it's important to realize now that we are seeing a relatively clear flow of news on this issue. And I think that we just have to realize is that, that can remain a cloud over sentiment as we head toward earnings season, because, this quarter ends in 2 to 3 weeks. All right, so those are the main things. So I want to just kind of mention that, and now we're going to get to the actual things on the S&P 500, S&P weekly chart here. Now, a really interesting thing I'm going to point out. Look at these pullbacks at different times here. So last week we pulled back to our lowest level from the second week of September. Now that was basically a 26-week low, which is about half a year. Now, if you look at the previous pullbacks we had, like for example in August, it was a 14-week pullback or a 14-week low, and then the pullback in mid-April was basically an 8-week low. So this is a more significant sort of deeper damage being done. If you look here, you can see a series of you can argue that these are, pretty much consistently higher lows until here. And now we seem to have something that is, not as much in that sort of, category. So this to me was important that suggests that we could be facing more kind of, structural on the weekly. So on the weekly now, the levels to me are not as clear on the weekly, but we are going to look on the daily for that. So let's look at now at the SPX on the daily chart here in TradingView. Remember, we use these on TradingView just because it allows me to easily kind of save things and know that they'll just kind of be there when I come back to it. We use TradeStation for a lot of stuff, especially when we do market trends. And in that, we also share some workspaces and things with you guys. Now, the zone I want to highlight is this 57.33 up to 57.73. It's the low from mid-January, basically to the low that we had back on the 4th. If you look at the 4th, we slammed down, and then we basically kind of held that at different points across here. So from my view, in some ways, this might be the first level people look at. So I do want to just kind of emphasize that this is very kind of, not super clear. That's why I kind of gave a zone. But the other thing is the 200-day moving average is up there. So from my view, people might be looking for a retest back up to that level. Now I'm going to jump over to TradeStation real quick. This is our hourly chart, the MTES workspace of the cash index and the futures that we show you guys. Now I want to mention here that, I'm not sure if it gave any clear signals, but you'll notice is the 50-hour moving average turned positive right here, which is shown by this custom study, this red line, the average, and this is each bar. But we see it started rising right here. And then once it started rising, it gave more of an upside bias. So it's interesting if you look at basically the drop, which was I guess this morning on stochastic. If you look at this, stochastic dropped to oversold with the 50-hour rising, and that was a potential buy signal using the method that we look at this on this, which is basically that you want 2 of the 3 pointing in your direction, especially if you have. It seems recently that the signal has been stochastic plus 50-hour moving average. MACD's been less relevant. So the key thing is the 50 hours rising, stochastic goes oversold. At other times, 50-hour was falling and stochastics went overbought, like right here, and you can see you got the drop. So this is something we share in our market trends webinar on Thursday at 2 p.m. If you want to check that out, there's also a link on the blog, and we have a workspace, and you have to first bring in the TradeStation studies to see that. But I want to just point out this workspace has shown these sort of signals, and it did kind of actually give a signal this morning at like 5 a.m. or 4 a.m. Eastern, if you trade futures and stuff. So I did want to mention that. Also want to point out that, if you look here, basically the 57.33 level is right at this kind of low back here on the 4th of March. But there's also a gap here on the hourly. Now, this was not a daily gap because this was the low that day on the 7th. So the 7th was a big day that we rallied up and slammed down. But the point is there is a kind of gap there on the hourly. So from my view here, this level up to 57.33 might be very much on people's minds. So that is just, want to show you on this hourly chart. Now, getting a little bit more long-term, but also using a daily chart, we can look here at this special chart I did with EMA ribbons, exponential moving average ribbons. Now, I want to point this out because if you look here, these other pullbacks, this shows a series of moving averages, a fast and then going down to slow. What you can see about these other pullbacks is the fast moving average never really got that low under the slow. Basically what this means is that the uptrend wasn't really violated too badly. But if we look in the most recent over here, it very much does cross under. So that's the first thing I want to show. The last time it did that was back here in the beginning of 2022. So I want to just kind of point that out. Another thing, and this is something that it doesn't have an exact measure because MACD is not a centered oscillator, but this is MACD. When you see a drop of this kind of just absolute, smooth, straight down kind of drop, in my experience, this sort of drop like this does not lend itself to quick reversals. It kind of becomes like an elephant sitting on the sitting on you or something. It just weighs you down. And so I think what something you have to realize is this kind of drop in MACD with the EMA crossover. These patterns are kind of reminiscent because if you look, I mean, these are reminiscent of early 2022 is what I'm trying to say, late 21. And the thing is, these other drops, you look at these drops here. This pullback, for example, in April came at a time when MACD was really, much more positive. And now you can see here it made this lower high, you get this kind of divergence. So I think at this point we have to realize is that these were more consistent with sort of the market was ripping higher and it had fast pullbacks and bounced hard. This time the market was showing signs of topping, and it kind of then surged to the downside. So from my view here, this is also consistent with what we said on this weekly chart of the fact that we're hitting these deeper lows. Now, it doesn't mean, of course, that everything is immediately bearish. I want to just point out that there are things here that are kind of pointing in that direction of the fact of trend having broken in a more significant way. So those are the main things also I wanted to point out. Also, it's interesting if you look here, the 50-day moving average and the 100-day moving average are both falling. That wasn't true at other times, really. Look at how these are 50 and the 100 are coming together. That's also kind of a sign of the longer term momentum weakening. All right, now let's get on to the cues. And I want to just, you know, looking at the cues here, from my view, we're now at a spot where we have this level from late October. We're kind of trying to hold, and again, I think we have to realize is that people might still see space further to the downside here. Now, the thing is, it doesn't mean that, for example, the market does weaken from here. Does it mean we necessarily go down to September lows? Not necessarily. It could simply mean that if there is a bounce that we basically just fish around in here, and it could be a period here where we basically enter a quagmire for months as we figure out, is there actually going to be a real ongoing, like, permanent trade war scenario? Is Apple going to actually get its act together in terms of, or not its act together, but is Apple going to have some positive catalyst? Is the negative stream in Tesla going to end, for example? And I think it's important just to realize that, because we're talking about this thing with Apple and the Siri, and then the analyst caught on and it got slammed. Does that actually turn into more trouble with Apple? They have some kind of thing coming out with they have a new phone coming out soon, and I don't have the details on it, but that is also could be a good thing, but it could also be not a good thing. So all these things right now are just a lot of uncertainty. So in that environment, people might look for a period of strength, a week or two, some upside of the market working off its oversold condition for a while. And then after a certain period of time, which could be based simply more on time than on levels of just, okay, we're going to basically stop going down for a week or two. Then at a certain point in time, momentum followers might be more looking in that direction. So I want to point out here, there's nothing here really this strong technically on the chart to me. This level is, a spot people will look for some kind of, attempt to kind of draw a line of defense, so to speak. But at the same time, we did violate it pretty clearly last week. So from my view here, this is something where people might kind of look for this to be a period of consolidation for a while, but not necessarily true support being established. Now, the Dow is also in a spot where it kind of broke that low. And again, this could be something where people sit and we just consolidate and chop. So I want to just point out now, again, this could turn into something where we actually hold and the bearish story doesn't come together and the bullish narrative returns. So I don't want to give any kind of clear sense of direction. It's more a question of the point that at this time, we're at a spot where it wasn't a smart bounce like the one we saw back here in January. It was a more kind of painful, violation of an important level. And I think at this point, it's more a question of waiting to see which of the two scenarios work out. And that's why I keep pointing to the Fed, because I do think that is going to be the linchpin, or it very well could be, I should say, of this week. It could be the Fed. And if anything's going to happen, people wait for the event, and then the continuation may follow the event. But before the event, we're just in this kind of holding pattern. That's the Dow. Now, the Russell also went down to the levels that we had identified. We basically drew this. It was up here somewhere up here when we drew this zone, and we went right down into that level, and now we've held it for now. So at this point, I think also we're in this sort of drifting area. I kind of feel like I want to just point out, I had not added something here, but I think we have to realize here is that around somewhere in this, I think we actually have a new zone on this one that should be added. And it's, basically between these levels here. I'm going to take this one away because this one did pan out. But we have this kind of this low from back in September, and then we also have the close from last week. So let's just make that white, and you can kind of see that's going to be the new kind of upside zone on something like RUT. Now, dollar index, we don't. I just have to return to it because, again, this is something that maybe I'm going to add. I don't historically this webinar. I have not looked at dollar index a lot, but I do want to just kind of talk about it a little. And I think it's interesting just to realize here is that this is also trying to hold here, but I think with the Fed and everything else coming in today's economic data, this might be something that has that kind of continued sort of weakness. And I will point out that this sell-off that we had there, that other week, the first full week of March, this sell-off in the dollar corresponded to the sell-off in U.S. equity. So, if this is actually happening of this overall rotation away from the United States and stocks and the dollar start to correlate, and I just say that happens for a lot of other countries. It historically has not happened for the United States. If we start to see the dollar and the S&P moving in the same direction, that actually could be a more structurally bearish, longer term issue for U.S. assets, because it means that people are viewing the United States overall as being a good or bad thing. Historically, people viewed stocks as good or cash as good, but if people start saying cash and the S&P are the same thing, that could also be a sign of more significant rotation away from U.S. assets. So then we have to realize that we had a warning sign. We talked about it at the time. It was a very significant correlation, completely ahistorical or unusual, atypical historically, I should say. A drop of this nature has only happened one other moment in time. You can go back and look. We talked about it. It's a trading view idea that we cited. But I want to just point out that this is something that I think we have to kind of continue to monitor it. And this can help us answer the question of, are we entering a longer term sort of rotation away from U.S. assets? Or is this simply, are we going to basically hold these levels and resume some kind of longer uptrend? That's the dollar index. Now, the 10-year, to me, this is also something that is a little bit potentially problematic for people who want to be bullish on equities. And the fact is that with today's economic data, the 10-year treasury yield has not been able to move significantly lower. And there is this important level that we've talked about for a long time. If you go way back, this level, it goes back to this spot in June of 2008. This was right before the financial crisis. It was in the midst of it, but before the real sell-off happened. It's this level at like 4.32 on the 10-year. I think it's 4.32. It was the high, 4.32 from June of 2008. So if you look, you can see that it's this yellow line over here, and you can see that it was this high in October 22. We kind of chopped on either side of it. It could just be something that has continued importance. I had taken it off my chart because we had a lot of these other lines kind of going across here, but I just didn't want to completely forget about it, because in my view, if we really do get above it and stay above it, look at how we held 4-1, like we had talked about as being the potential downside, and we have this. Look at this hammer where we came shooting right back up. That looks very different than what the S&P with the Qs did. The Qs went down under their level. This one had a hammer above the level. So again, I just want to point out, if we are seeing upside in treasury yields and we're seeing downside in the dollar, downside in the S&P, it also fits into this potential narrative rotation away from U.S. assets. So I think we just have to hold that out there as something that might be a possibility. All right, so that was the 10-year. So I'm continuing to watch this here. And, from my view, the fact that it bounced so sharply at 4.1, this might still be pointing to the upside. Look at this level that we had. The level we had in January was slightly above this level that we had in April. So I think, again, higher high, higher low. I don't know. If we see yields moving higher at the same time the economy continues to weaken, again, these are things that people might not be happy to see. All right, now the XLB, this, in my view here, again, like we had talked about overall, the main focus is the S&P 500 here. The XLB has some strength from the weaker dollar, having much of a clear sort of read on this chart. So at this point, I had mentioned the higher, the lower high, the lower high with the potential for some pull down here. But at the same time, with the Fed coming, the potential of a dovish Fed, we also have to realize that this might be something that doesn't necessarily give us a lot of much of anything in the near term. Energy, actually, communications first, XLC. This is holding that important level we had talked about, and I think this is one also. Look at how quickly this one held that level, unlike the overall Qs. The XLC is one of the stronger overall charts. From my perspective, if we do see a stability in the overall U.S. growth, S&P, NASDAQ, whatever you want to call it, big story, of the growth oriented sectors, XLC continues to potentially show the strongest overall technicals on the weekly chart. XLC doesn't have the same kind of exposure to tariffs. They don't have the same exposure to things like semiconductors or things even like the cyclical economy, the way consumer discretionaries do, or other stuff. So in some ways, they're kind of in their own space. Meta, Netflix, some of the telecoms have been very strong. So I want to just kind of point that out on XLC. XLE, I think, is actually the one that's kind of most interesting here. Now, as people watch me for a while know that I've, for a long time kind of been highlighting the potential of a lot of oil supply coming into the market, but that has not been happening. Instead, we basically see the United States having some new tensions in the Middle East with Yemen, President Trump threatening Iran and things like that. So I think we're at a spot here where we might be also this focus on the global growth story. So all these things together here might actually be putting us in a spot where the XLE, the energy ETF, actually has some potential space to the upside. People looking for value stocks also might see XLE as having the most potential, or at least maybe not the most, but some potential because they trade at very low multiples. So I want to just kind of point that out here. We had this triangle that's kind of resolved now. I wanted to leave it on the chart, but now I'm going to take it off my chart because it's over. I want to leave it up for you guys. But anyway, I want to just kind of point that out. And now I think this is something where it's very much neutral, but it has essentially this range between 83 and 98. And I think we want to kind of watch it here. But let's actually look on the daily because XLE on the daily here. I mean, this is something here where people might see this as being a little bit more of let me take this arrow off. This is something here that is potentially more in a squeezing sort of position. So when things are supposed to go down and they hold instead, and this has been a long time if it was going to break down and had the potential to do that. We have weak economic data and XLE pushing higher. That's maybe a sign that people are seeing more of an opportunity and there's more actual buying interest than selling interest. XLF also has some interesting fundamentals. I want to just mention that the only trillion-dollar company, the best performing, I should say, trillion-dollar company this year is Berkshire Hathaway. I'm not going to show it now on TradeStation, but you can rank that on TradeStation, rank by market cap. Berkshire Hathaway and property and casualty stocks are really doing well. I know they're not very interesting, but the fact is they're also supporting XLF. There is the argument of XLF and the financials having deregulation benefiting them. The fact is that they've been well capitalized coming out of the financial crisis. So I think it's interesting that European banks did very well even when Europe was struggling badly. And so I think even if the American economy weakens, it doesn't necessarily mean financials are going to be in that bad of a spot. So I think when we look at it here, it's holding this level. Look how it smartly came back from under that support level. So from my perspective here, financials are in a spot where they are kind of holding some longer term levels. And I think people want to kind of, bear that in mind. Nonetheless, I think we also have to realize is that these guys do have a degree of kind of, um, just overall cyclical risk. But at this point, the weekly patterns on the XLF and point XLF, XLC, they have similar charts, and it does show that people are favoring them to a certain extent over XLK and XLY, which is the tech and the consumer discretionary. XLI, this one though has some other kinds of things. This channel, nothing really invalidates it. So I want to kind of point this out. This is one here where people may continue to see this get pulled down toward this kind of 126 level. That's XLI. XLK also at this spot is very much like the Qs. It's under the support level. It has this kind of hammer here. People may see some potential for some upside to a certain extent. However, at the same time, this might be something that people kind of wait and watch. Does Apple fix, accomplish things and everything else like that? So Microsoft, not, has not been performing particularly well. So those sort of things just kind of weighing here. Some of the overall earnings for software and stuff have not been massively strong. So right here, XLK may have this kind of sideways space. XLP, I mean, it's interesting. It's holding this level we cited. So at this point, I'm just I think the key thing is it held this level, and I'm not really sure how much more to say about this, aside from the fact that we are seeing this kind of value. People are buying value stocks today, and something like XLP may continue to benefit for now. People are latching on to stuff like property and casualty, real estate, consumer staples. That sort of thing can kind of give people a sense of comfort in a market that is afraid of a slowing economy. So here, XLP holding this level. However, I do think it's important to realize that it does have a broader range, and this might be something that it can do well for a few days, and then suddenly you come in and it's not doing so well very quickly. It can give up many days of gains very quickly. XLRE real estate. Also, I mean, does potentially seem to be forming this channel. I think we have to realize it does potentially benefit from lower rates, but at the same time, it does have a degree of economic cyclicality in terms of shopping centers and offices and things like that. And if we do see, yields continue to push higher, this might not be something that people really want to embrace the fundamentals as much. We had talked about this potential squeeze higher, but the key thing here is that yields are not breaking under 4%. And I think that might be something that becomes a problem. So I think right now, XLRE is something people need to think about. What's the 10-year doing? XLU, on the other hand, we had kind of put this channel on here, but I'm not going to remove this channel because at this point in time, I think the key thing is it kind of held this level nicely. It's very tight here. This isn't economically, safe haven sort of thing. So from my view here, this holding this level around 75 and a half, it's in this range, but if it gets up above this range around 80 and a half, people may actually look for this to kind of continue higher. They may view it as a kind of safe haven way to benefit from the long-term growth in AI without having the same kind of risk you have from being exposed to the hardware names and the things like Supermicro and the really kind of volatile, tech stocks, because utilities have that certain connection. XLV. It's interesting to see that it's now established this new level. This is a healthcare ETF. And I think this is one here where it's one of the leaders on a year-to-date basis. It retraced 50% and it held. So I think right here, now we're forming an inside week, beginning of an inside week, but this is something here where people may actually look for this to move its way back up toward the highs. I mean, there's just always something with this where who knows what's going to happen with Medicaid, Medicare, all these different things where the government is in one way or another connected to healthcare. So, I mean, I think it has some, people may see risk in it, but at the same time, when you look at it technically, the chart here is giving a sense that this actually is holding. It's a non-cyclical area, so it's kind of like consumer staples where people may feel comfort in it at a time when when they're worried about the overall economic situation. And the last one, XLY, which is consumer discretionaries. This has pulled back to a very significant level, and people may look for, there's a lot of space here where it could potentially rebound up. Now, I would say, if anything, the level to watch on this, it could very well be something like just last week's high, or less the open and the high, maybe more where people are looking on this. So great to see everyone. Thanks for joining me. Sorry I ran a little bit over. We will be back on Thursday afternoon at 2 p.m. with market trends. I hope everyone has a great day. I'll see you on Thursday. Thank you very much.